A lot of experts are predicting a bear market or a recession. But is that really the case? We're going to explore that a little bit today. Stay tuned. Be fearful when others are greedy, and be greedy when others are fearful. Warren Buffett once said that, and he's talking about the stock market. So this week, I want to dive into more around the stock market news, a lot of the fear that's been coming out, and really give the other side of the story, right? We hear a lot of these guys come out in the news. They're really hey, everything's going to crash, the doomsdayers, right? They're always trying to predict that things are going to go down. We're going towards a recession. And at some point, they're right. We just don't think they're going to be right this year. So I wanted to provide the other side of the coin, which is our view, going into some of the people who we follow, mainly some of the big economists. And for that, I want to show this article that came out from Ed Yardeni, who I talked about in my last video, who is really one of the voices that I lean on and look to see kind of what they're thinking around all of this, because it's more of a silent voice, right? You don't see him in the headlines as much. And I think it's a really interesting and good perspective. So here we are. One of the biggest ones that he talks about is the cause and effect of bear markets. Now, bear markets are typically caused by recessions, right? And recessions are typically triggered by credit crunches. And when we think about what a credit crunch is, right, it's the idea that there's not enough liquidity in the market for people to go out and borrow and utilize in their life, whether it's for cars, for houses, or for businesses, right? Businesses being the big one because small business owners, right, going out, lending, getting that money to start up a business, infuse their business with cash, right, to start doing maybe research development, producing more products, right? That's what can drive the economy forward, is the idea of leveraging out some of that money and that credit. And so one of the big ideas that's come out of that is, if the Fed is raising interest rates, will that cap some of the liquidity, some of the cash that's available to these banks, to these lenders? And what seems to be the case is that's not necessarily what the data shows. It looks like there's around 3 million of excess in M2, which is basically the money on hand throughout the banking system. And it's not hard to see that that's a lot of money to be passed around. And so even if the Fed does go around and increase the interest rate, which they've talked about doing this year, we don't see that breaking the back of the market, right? Really crunching down on liquidity and drying some things up. When you think about where the market sits today, there's been a lot of comparisons, mainly to the Volcker era, which was in the 70s, where inflation was really high and interest rates were starting to get, really high as well. Well, in that scenario, Paul Volcker raised interest rates to something like 20%, right? The Fed funds rate right now sits at 0.25%, and they've been talking about raising that rate to something like 1 to 2% this year, by the end of this year. Now, that's not to say something bad could come from that, but that's a pretty big difference from 2% to 20%, which, in the 70s eventually led to that recession because they had to raise interest rates to squash inflation, and ended up working, and kind of the rest is history. But all that to say is we're still very far from that. The Fed is obviously very closely watching everything, and they want to ensure that that scenario doesn't take place. And so we think that's very mindful of them, and really we don't see that as a material reason why things would start, completely capitulating. The other big one is that there seems to be still a lot of pent-up demand. And one of the biggest areas in that demand is consumer spending, right? We've seen a lot of the slowdown in consumer spending because of the Omicron variant that came out mainly around the winter, workers calling out sick, people not being able to travel. Still, some of the consumer spending has come down because of that. And even though it's come down, it's not because of other outlying factors, right? It's mainly around this virus still. And so when you think about that and some of the supply chain issues, mainly around the auto industry, where you still drive by the auto lot, they have no inventory, the dealers are jacking up the prices, right? So once all that stuff keeps coming back online and keeps ramping up, we think that's still going to be really good for the economy because it's still going to drive consumers to spend. They're just kind of sitting on our hand. We're kind of sitting on our hands going, okay, when all this stuff kind of comes back online, we're ready to get out there and spend because we still want to go take those trips. We still need to get some new cars, right? All those things that we've talked about that have kind of been sitting on hold, not because things have gotten too expensive that we can't go out and do these things, although inflation is hurting a little bit, but the idea that there's still a ton of demand for those areas that just don't have the supply. So as the supply comes online, then you should start to see more of that spending, which, as you talk about spending, is what drives everything, right? It goes to the business then reinvests that money, and on it goes. And so we think and so does Ed, he thinks there's material value in all of that's being one of the things that's not being talked about because it can end up being a very good thing for the economy. Now, one of the other areas that he's talked about is, oil, obviously, and the whole geopolitics around oil and where things have gone, where things might end up. And, even though he's talking about oil hovering around $80 a barrel, right, he expects to see more production in the U.S. now that price is drifting higher. And of course, that's natural, right? These oil producers have a set cost in their head as to how much it costs them to produce a barrel of oil. And once they've gotten above and beyond that threshold, they're going to try and produce as much as they can, right? Because all the rest is gravy. And we've heard specifically from some producers that somewhere around $34 to $36 a barrel they can produce and essentially break even. So anything above that is additional profit. So at some point, right, some of that stuff's going to start coming back, and they're going to start getting the rigs back online that they've kind of stalled through the pandemic as people slowed down. And so you'll start to see some of that ramp back up, and that may help some or all of this kind of come back. One of the other ones that he mentions is the idea of valuations, right? So when you look at the market, it's just like when you go shopping, right? You see some things on sale, you see some things that are probably about what you would expect to pay, and then you see some things that are just really overpriced. And in this current environment, especially from the start of the new year, we haven't seen things get absorbently high, right? The market isn't necessarily taking off into speculation territory where you see the dog walker telling you about the next hot and ready stock that they've purchased. You've seen that in some of the meme stocks around GameStop, AMC, right? That got a lot of the headlines because people were just pumping money into those things like crazy because they didn't want to miss out. And when you look at the history of what that looked like and where it ended up, that was actually a really bad deal for a lot of people because it's all speculation. And where you see things today and where they land is the market isn't necessarily what they call overvalued, right? Where things aren't so crazy expensive that we shouldn't be paying for anything, but they're also not on sale. And so we still sit in this relatively neutral zone of, well, everything's kind of about what it should cost. And even though we're looking forward to companies continue to make money and invest in their own companies, it doesn't seem like, from what the numbers are telling us, that anything's being propped up out of the ordinary. Of course, there's going to be stocks, at different times that are in that zone, and other stocks that may be considered cheap but may not be good just to buy because of what they do. But it looks like from where we've fallen from the start of the new year, everything's kind of settling in a little bit here, and it's not crazy expensive. So that's another big reason to just be careful. And he talks about it here in the and what he calls the forward PE, which is some of these technical terms around measuring the valuation of the stock market, the sentiment of the stock market, and kind of going from there. But this is kind of rebuttal as to the idea that things have really gotten speculative and everything's kind of just off to the races. It doesn't appear to be that that's the case. It just appears to be more of this noise coming out and really just driving a lot of the headlines. So again, we don't see any material reason to change strategy. right? There's still a lot of things that, if you have a lot of ideas, like if you have some cash, there may be some times to get into the market at this point because things have kind of gotten beaten up from the beginning of the year. If you're still invested, there's no reason to change course because this is just part of the normal cycles, right? The ups and downs of the market. And more so over the last couple of months, we've seen some bigger ups and some bigger downs. You're going to probably continue to see more of the same, right, until some of these earnings start to come out and really show where these companies stand. And we've had so far this week has been some of the earnings starting to come out, and of course the earnings have been relatively positive. So it's not like things are getting beaten up. It's not like the economy is really beating up a lot of these stocks from the earnings perspective. Of course, there's always going to be, give and take, and depending on what the stock is, but we don't see any material value to change course. Again, it's still the idea of you've got some cash, maybe pick some time to infuse some of that cash. If you're invested, let's stay invested. There's no reason to rotate and get all crazy into cash and be worried. There's always something to be worried about. That's why you lean on us, you rely on us. And that's why we're doing a lot of this stuff in the background, right? Reading through some of these experts, where they see things, implementing that into our portfolios and how we manage your money. And we hope that that eventually leads to success over the long term for your portfolio. So if you have questions, comments, concerns, let us know. Please reach out to us if you're wary at all about where the market is. We'll kind of run through where you stand. If you enjoyed this video, give it a like, subscribe. If you got friends, family members who are really struggling because they're just worried, scared, they don't know where they sit financially, gosh, let us know. Send them our way. We'd be happy to talk them through, get them on a plan so that they know exactly where they sit, where they're going, and how they're going to live their lives given what they have or what they may yet to have. So, as always, I hope you enjoyed this video. Have a great rest of your week, and until next time, have a great day.